Welcome back. Episode 47, Pickers Market.
Yeah.
Great.
Keith is back with us.
I am.
Travel.
It's been a while.
You're
Yeah.
the travel expert here.
Mhm.
I mean, you traveled basically around all of Michigan last
Yeah.
week.
Last week I was in Michigan for 4 days and just kind of traveled all around the
Mhm.
state. So it's great. I mean, I'm from a small town, Minnesota, central Minnesota, and driving around Michigan felt exactly like being at home. So it's yeah, it was good. I mean, met quite a few advisors and clients and client events, and generally speaking, the mood was pretty good considering the fact that we've had a pullback, a correction we've
Yeah.
hit officially the other day. So, but generally people are fine with things. People are still working. Economy's good. Got some positive comments on your special report you did the week before when we talked about when the first pullback
Yeah.
was happening in the market. So it's good to see. So no, it's good to get out and see our advisors and their clients and see what kind of questions they have maybe that we're not hearing,
Yeah.
as we sit here.
Was there any that stood out? I mean, I would guess it would be more about tariffs. and
Yeah,
what's
there's
going
obviously
on,
a
but-
lot of tariff talk, and I thought the mood would be a little worse. What surprised me was, I think you and I talked offline the other day, was that people were actually a little more accepting of tariffs than I thought they would be,
Mhm.
even though that, we haven't kind of seen the end cost going up to the consumer yet.
Yeah.
So that may change when that happens, but I think they generally like potentially where things are going and some of maybe the positives that we haven't heard yet. I
Yeah.
think people are willing to right now wait it out and kind of wait for that positive outcome, and kind of they're gravitating towards potential American jobs coming back and
Mhm.
looking forward to that. So, which will surprise me when
Yeah.
people are, maybe it'll be different when they open their quarterly statements and
Yeah.
they actually see a negative number instead of a positive number. But
Mm.
I was surprised. I think you had that feedback a few
Yeah.
weeks ago too
Yeah,
from one of your
same
events.
concept.
Yeah, which surprised me. I figured it'd be a little bit more harping on these things are awful. You got to
Yeah.
get rid of this. So pleased on that.
All right, episode 47. I went with John Lynch.
Nice.
At least I'm guessing no
I'm
recollection.
tapping
on-
out of this
yeah.
discussion.
I like that tapping out.
I mean, the only reason I really know John Lynch just mainly is from his general manager role with the
Yeah.
49ers, but football Hall of Fame safety.
Yeah.
Award
Solid.
number 47.
Yeah, I
So-
can't think of any other 47s that would.
I
Yeah.
asked ChatGPT, and they're really
That's what we got.
that was basically the only
That's
noteworthy.
it's fair.
Name.
It's good.
So at least we had somebody for
There we go.
47.
Better than some of the scientific fun facts you
Yeah,
may be throwing out at us.
figured I would
You
leave that
couldn't
one
find
out.
a
Yeah,
47
Oh, there's
degrees.
plenty of those, yeah. but figured I'd leave those ones out.
All right.
Hot button today. Market officially last week on Thursday went into correction territory. We've since, market on Friday and Monday had a nice little
Nice. Oh.
bounce back, but nonetheless, the market did go into correction territory, which is down 10%. I just want to throw some things out there because, I think a lot of people get worked up about market pullbacks. Even if you see a 5% pullback, I feel like we start getting questions on what's happening to the markets, and you see CNBC has markets in turmoil and all things like that, right? So the average correction since 1982 has been a 14% pullback from the recent highs.
That's interesting. It's a little bit more I would have thought of,
Right.
But yeah,
Mhm.
That's an average. So
Yeah.
even if you take the median is 10% spot on.
Mhm.
interesting.
So, and I think the last couple of years, I mean, last year we didn't have the 10% correction. The year before that we did. And then you're getting back to 2022 where the market was down. What was it down
Almost
at?
20%,
Yeah,
19
so-
something, I believe.
But I feel like we've gone through periods, and we always have that recency bias. And I want to get your guys' thoughts on this, but we have the recency bias where we'll go 3 or 4 months without a lot of volatility. And then all of a sudden you see the volatility come back and people start getting concerned. Is that, I mean, Keith, you've been in the business a lot longer than we have. So is that like normal all the time? Or is it just,
Yeah, I think it's a recency biasness, right? I mean, if you go back to the last 2 years, up 25% plus in both 23 and 24. So now all of a sudden we start this year, everything's all great, new administration, we like where things are going, unemployment's fantastic, and we're up 4% to start the year, and then we have a correction. We touched the other day down 10%. So it's like, what's going on? It's like, this is not normal, but your stats are exactly right. If you go back, corrections do happen. They should happen about once a year. We just haven't had them for a couple of years, and you forget about 2022. Does anybody remember 2020?
Yeah.
Right? That was It's quite a bit of a 35% in 5 weeks.
Yeah.
So people do forget about it. And I think it was 2017 or 18 where the market literally didn't straight up
17.
17
Yeah.
didn't deviate at all. There was no volatility.
Nope.
That's like the perfect market
It
for
was like 30 basis points every
every
single
day, right? And just finished out nicely. I mean, that's a perfect market for investors and clients.
Yeah.
Not a whole lot of questions. Things are good, but it's just like that's really not normal. So I think again, I think it's recency bias. You have an opinion on that, Lisa?
No, I mean, first of all, like correction is a fairly neutral expression for what can feel very painful
Yeah.
to investors, right? But I also agree with that. It's more likely we forget about the prior one pretty quick, and it always feels like, oh my god, this is it now. This is the one now.
Yeah.
It's going all downhill from now. So I think that really feeds into the recency bias. Hey, you forget about everything before and just see that as the doom and gloom. Yeah.
The other part of corrections and just any market pullback in general that I always find interesting is stocks are at that point, stocks are usually on sale, right? Valuations are cheaper, the stock prices are lower, but nobody wants to buy, right? So I always use this comparison of like, Black Friday shopping, stores are packed because a store might have a 5% discount on an item. And all of a sudden that's such a better deal than buying it full price, right? But nobody does it with the market.
No, it's weird. That's
why.
Generally, I think people like to see things going up in that, right? And so then all of a sudden you look at your statements and it's like, oh, I got more money. And it's just like, that's great. And all of a sudden when you have also a correction or even a 5% pullback, it's like, well, what's going on here? There's got to be an issue, right? So you're worried about the next shoe to drop. And I think, but you're right. It should be the opposite. It should be when, I think that's where Warren Buffett, he's kind of the greatest contrarian, he's waiting for big sales and that's when he steps in and buys big chunks of business. I mean, the market for the last couple of decades, though, has been a little bit more, not momentum investing, but kind of momentum investing, setting new highs, things are all good. So it's like, if we're seeing a correction, now it's like, oh my goodness, the correction may turn into a bear market. So I'm going to start panicking instead of stepping in, which generally speaking is what we do when things are on sale, right? We actually start adding those positions to our portfolio that we may have missed for some reason on the upside.
Well, maybe it's not the right time necessarily to buy, right? Maybe there is that other shoe, but at least, that's where we can talk about dollar cost averaging comes in. Especially if you're buying the market, right? Now it's, Lisa, tell me if it's different when you're doing a stock versus the market. But in my opinion, if you're buying the market and dollar cost averaging into 500 companies, it's a lot easier to do personally versus, one specific stock, right? Because there's a lot of different fundamentals that go on with a specific stock versus a more diversified approach. So do you think it's better to dollar cost average or try to time it and call bottom?
Well, that is the thing that always everyone wants, right?
Yeah.
Buy low and sell high. Normally what investors do is the exact opposite.
Yeah.
Because of fear. And you just mentioned like the connection to retail, right?
Yeah.
And I think what is normally also like, I think overall it's very psychological and emotional.
Yeah.
And also
exactly it.
like that is the part I think that feeds into it the most. But also when you think of retail, hey, you buy something that is on sale and then you do not track prices anymore. And you thought you got a good discount and a good deal. You track the prices and you see that every single day of the purchase that you make with a single stock or with whatever you buy. You see it in your portfolio. Maybe you're afraid of, it can go lower than this, right? You do not wait for a retail discount to get even lower than what it is at the moment. So I think overall it's psychological. And I think we saw that, and I always like to use, and you mentioned it before, the example of 2020, March 2020. Like that was all psychological. It was herd mentality, biases. Like everyone thought the world is ending tomorrow, right? It's like that was nothing on fundamentals that changed so dramatically at this point that we knew what actually influences would it have on businesses. That was just panic. And it was just emotional, basically. So I think that's the largest part to it.
Yeah, and then when you get in those situations, that's really when again, been doing this a long time, when I get that kind of pit in my stomach that things are really bad, that's usually a time you need to be stepping in.
Yeah.
And it's hard to do, right? Because
Yeah.
your net worth as an investor or an individual is actually going down too. I think that's a little bit of a difference of looking for whether it's a car on sale or clothes, right?
Because you see
that you've been watching that price and hope it hits somewhere. It's like if you're watching,
but your net worth is probably going down if you're spending it.
Yeah, a little bit. Yeah, I mean,
it's just a different.
It's a different angle to look at it.
Yeah, but you're purchasing something that
Yeah.
you wanted to, right? Whereas normally, if you're in the market, right, you want to continue to go up,
Yeah.
to grow your net assets, right? Whereas
So
you know
keep
you're going to make
buying
that.
those clothes.
Yeah. So anyway, keep buying stuff because that does keep the economy going. So we like that. we do like
We
that.
like that.
So.
Yeah.
Well, and the other part of it too, going back to the correction side, is corrections don't always lead to bear markets, and future performance tends to be pretty good.
Mm-hmm.
Now, again, I think timing is, you have to take timing out of the picture because trying to time the bottom is impossible.
Yeah, I don't think
Absolutely.
anybody. I mean, if anybody says they can time the market, they're really not.
And then I
the
think
truth.
you get the flip side of it is if the market does start to rebound, like take COVID for example, like the in 2020 the market rebounded so fast, and if you had gone to cash at any point, I think number one, you miss out because you don't know when it's going to start to go up. But the other side of that is if you start to see the market go higher and you're still in cash, it's harder to buy at that point again, because now you're waiting for the market to come back down to that low point, right?
Yeah.
Would you agree?
100% agree. It's like in 2020 was a perfect example. And then even in 08 and 09, right, when the markets were down for a couple of years in a row, it's hard once you make that decision to go to cash. Now you got to make the correct decision to go back into the market. And the COVID bounce is probably the prime example. We're down 35% in a matter of 5 weeks. We didn't know where the bottom was, but we were generally telling our advisors and clients, if you have money on the side, this is where you should be putting it. We think it's a buying opportunity. Valuations were very reasonable.
Maybe get more aggressive.
Right? You, instead of tilting from, if you were a moderate growth to a balance, you'd go from moderate growth to all growth investor. So we're telling people that, and we didn't know what the market would do going forward, but what happened the next 1 year period, which I think shocked even the people that were more bullish, was it was up 100%.
Yeah.
And to your point of all of a sudden, say you missed the first couple months of run where the market's rallied 25%, you're like, oh dang, I'm gonna wait till it pulls back to the lows, and then you miss it, and then it's up 50, and then you're like, even your pain point's even higher of like trying to get back in.
Yeah, because how much more can it grow, right?
Yeah, and admitting that you were wrong going to cash, and then you have to make so many more decisions to be made. That's why, generally speaking, we always talk about long-term investing, sticking to your plan, right? Because the market does have these wiggles and waggles here of, pull back and this 10% correction that we're in right now. Do I think we're going to a bear market? Personally, I don't. That's another bear market you mentioned is generally the official thing is down 20% from the peak.
Yeah.
So we are in correction territory, but how many days have been in correction so far? I mean, we're only
technically
just one, right?
Yeah. I mean, technically we're not in a correction anymore because of the performance we had on Friday and Monday.
Yeah.
So we touched the correction point one day. So
and it was like I think the market closed like 10.03.
Yeah. So barely
so it's like 3 basis points into correction territory. So not too big.
No.
But the other part of this is how many corrections turn into bear markets. And I think you had sent this chart over because I thought it was really interesting. And I wanted to bring it up. And this is since World War II also. So this is going back further than my 1982 on the correction side. So there have been 48 10% corrections, and only 12 of those have turned into a down 20% or more. So that's 25%, right? So it's hard for the market to get down 20%. There has to be some catalyst where there's a lot of concern, even past recessions. Like there has to be some black swan type of thing that gets us there.
Yeah.
Right. So just because we go into this correction, I mean, we talked about it, the down 10%, the median over the last 40 years, right? That's a normal course of business. And they don't always turn into these bear markets as much as the media likes to throw out there. Do you guys think the media is more of the issue?
Go ahead, Lisa. Yeah, it's this one.
I think yes, because I mean, we listen to CNBC all day, every day, right? And they're like, sometimes it seems they're waiting for that, right? Because they have something to latch on for the whole week, for 24 hours a day. They have something talk about and to latch on, right? It's ridiculous. And also not only the media, but also the how we consume it and how it changed over the years, right? Now we have it like in our phones, right?
That's true.
All day, every day. That was not possible years ago, right? Which is like we were not completely barraged with all that information all the time, right? We had to take active steps to actually get those informations. And now we have it in on our phones. And not only the media that kind of dramatizes all of that, but also like social media especially. And we have all and when I'm bored, I look at in kind of social media and I look for all those finance gurus and finance influencers, because it's just, I mean, it's actually pretty bad, right? But it's fun to look at if you know what's going on, right? But there's like, everybody can post something. Everyone is now a finance guru, like, and it's such a dangerous information for people who rely on that, right? They come with flashy numbers and loud and all of that. They draw a lot of attention, with sometimes not being anything educational behind that or any merit behind that, right? And I think that is the dangerous part for people who rely on information to get their education about stocks and investing, and who are interested in that. It's easy nowadays to tap in those traps, and I think social media even more than the media overall.
Yeah, 100% agree with you. Summed it up well. I mean, the thing is, when all this instant media, and what do they want? They want viewership and to attract eyeballs. And so, and again, the country's, and I don't want to talk politics, it's fairly divided. So tariffs, one thing we've talked to death forever. It's like, but there's a lot of mistruths on both sides of tariffs. And so last week when I was in Michigan doing some presentations, I tried to at least kind of give the facts of these are what tariffs are. This is how much they raise. This is the potential, instead of just saying these are all really good or these are all disasters as well. And I think that's part of social media and attracting eyeballs, and whether it's whatever website you go to or Twitter, there's always back and forth, which sometimes you can find some really good legit nuggets to read, but other times it's they have some kind of angle or some kind of desire for you to do something,
to go in a different direction.
Whether it's chase the fear factor, chase gold and things like that. And when gold's been fantastic, but there's definitely a lot of that kind of information.
Well, and you can cherry pick the data points too, right? From an economic standpoint, I mean, in 2023, when the economy was doing great, you could still find areas that you could cherry pick and say, well, look, I think we're having a recession because of XYZ data point shows this.
Do you remember how many people were calling for a recession? Almost everybody was calling for a recession.
Well, that was back in 23.
Yeah,
22, 23.
Yeah, right. And that never happened. So 22, the stock market was bad.
Yep.
Then everybody assumed that was calling for a potential recession. And I would say 9 out of 10 people in the investor world were talking recession's going to happen, and just the opposite. And that's why we've had 2 fantastic years off that low.
Yeah.
And to go back to the charts that you said, sometimes you can tell a complete different story, like 2 complete opposite stories with the same chart, right? There's a quote like, do not trust a chart that you did not manipulate yourself. That was always a quote in during university and during the studies. Hey, do not trust any chart that you did not manipulate yourself. Which is, I mean, you can tell different stories and different angles. Whatever side you're coming from, right?
To your point, Tyler, that chart of 25% of the time we go from a correction to a bear, it's good information to know, right? I mean, history doesn't repeat itself, but it's nice to know the facts of how often. It's like, just because we go into correction, and I think a lot of people's mind in the media, if you listen to it recently, it says, oh my gosh, we're going into a bear market. But historically shows you it's been 25% of the time.
Yeah. And I think you'd have to have a catalyst on top of this beyond tariffs to push us into that.
Yeah.
Maybe it's just tariffs go on forever and there's no ending point. Who knows? But
could be.
I think there has to be another catalyst on top of this that pushes us there. So my question for you guys is, how should investors handle these types of situations?
Yeah, I mean, what
were you telling people at the client events? And
I mean, even going into this year, I'll back it up just from our great investment pitch this year was bring an umbrella, right? That was kind of our theme, which normally don't have a theme, but this year Jeremy brought it up, was bring an umbrella. And I was like, yeah, that sounds like a great theme. And what we mean by that is, when you're generally bringing an umbrella somewhere, you're expecting potential rain, or maybe in our case, we're expecting some market volatility and maybe a pullback. And again, if you bring an umbrella, it could be sunny out and you don't have to worry about it. So that was our bring an umbrella pitch was. So it was like basically giving investors, our clients and advisors, a warning that we're seeing the last 2 years been fantastic. Now we're expecting anything really bad to happen, a hurricane or something, but we may see some rain. And I think that's kind of what we're in this bring an umbrella, which, some of the things that we were telling clients to do is like rebalance. If you were a 60-40, meaning you had 60% stocks, 40 for the last 2 years, that's now morphed to 70% stocks, 30% bonds. Just rebalance. If your clients, goals haven't changed, you should now go back to 60-40 and take that 10% and move it back into more safer assets. And then you would be a little protected in this. Again, we're down, I think year to date was at 4%,
about 4.5%.
Yeah. As of, midweek this week. So it's,
it's not a disaster.
No, we're up 60% and we're down, for 2 years in the stock market. And now we're down year to date 4.5%. It's not bad, but that's what bringing an umbrella. So if you do that, and then if it pulls back a little bit more, you maybe have some of that dry powder on the sidelines that you can put back into the market.
Yeah. Thoughts? What do investors do?
I mean, generally when I was kind of at events lately, presenting, hey, bring an umbrella to slide, I was like, even if it hurts to kind of see all of that volatility at the moment, kind of and it sounds silly, but take a deep breath and zoom out a little bit, right?
Mm-hmm.
And then I always bring the charts, like the correction charts. Hey, look at that. This happens every single year. This is nothing that we have to be afraid of, but it is something we need to be prepared for, right? And financial plan, if that is set up, is prepared for that, because it is a reoccurrence that happens every year. So it is kind of take into account in that, and also kind of show like, hey, overall, like history rewards investors that stay in the game, right? And do not panic. And we see that with the multiple charts that we have over 70% of the years altogether since back to World War II, I think, as well, are actually positive years, right?
Yeah.
And so I think zooming out a little bit and seeing a little bit more high level is really helpful here, and kind of bringing back your goals, what you actually want to reach, right? Your overall financial plan that is set up long term and is set up to weather that exact situations, kind of helps a little bit to get out of the headline slump and of the, oh my God, it's just bad.
Panic.
Right? It kind of helps a little bit to take a breathe and kind of see what history suggests, and kind of where you are with your plan, which is probably a little bit ahead if you were invested the last 2 years, which have been great. So I think that is the overall. It seems simple, right? But it is.
It's hard because when markets go down, it's hard to buy, and it's hard to like stay invested.
Absolutely,
as well.
And there's no sugarcoating on it that it's hurtful and painful, right?
Yeah.
But kind of zooming out a little bit and kind of reassess your situation, your risk levels, your overall plan for what the purpose is, and kind of see, hey, what is history doing, and what are we kind of looking at here?
I always bring it back to the financial plan, and you touched on it, where the last 2 years the market has been up compounded. What is it, 59,
60%, say 60%, like almost.
So the chance that, regardless of how you're invested, if you're balanced growth, the chance that you're ahead of your plan is highly likely, right? And so this current correction of 10%, even if you combine this plus the last 2 years, you're still up 50% for the last 2.5 years, which, I would guess most financial plans probably have a 6-7% annualized return or so built into the plan.
Yeah. So you're talking what, 16-18% maybe.
So you're still doing fine. It's just, if you feel this way, let's reassess that risk that you're willing to take. And if where we're at is still too much risk, then let's dial it back a little bit. And that's how I usually approach it.
Yeah, no, it's great advice too. And I think that helps. At least you said, take that step back and just take a big picture. And again, now if you were the person that maybe invested in, end of February or something, when the market started rolling over or end of January, then it's probably a little more painful. But generally speaking, our clientele and advisors are people that are in retirement or pre-retirement. So you kind of got that little bit longer picture. And
well, an interesting part of this is if you invested in 2008 at the start of 2008, and your first 2 years were negative, and you continued to invest and hold the S&P 500, all the way up until this year, your annualized return still would have come out as 11%.
That's crazy. And that was painful. Again,
and that's down 36% and down whatever, right?
18 or 20
at the start, right? To start your investment returns, you're down.
Picking the worst possible start in the last couple. And that was, I mean, I've been doing this, you're dating me, I've been doing it for almost 30 years. That was by far the worst period. The tech crash in 2000 was, kind of painful, and it took a while for those tech names to come back. But 2008-9 was just bad. I mean, the financial system's all gummed up. It was people are losing their jobs, uncertainty abound, big companies just collapsing overnight. It was just bad. Whereas the COVID was quick, that 35% in 5 weeks, and
there was nothing bad with companies actually.
Nothing bad with the companies, right? Once the economy reopened, it was boom, and everything was good. So 08 and 09. Whereas now we have a correction. I don't see any of that stuff going on. I mean, again,
there's some underlying stuff,
but it's consumers maybe weakening a little bit, but not
anything concerning.
Yep.
And again, it brings back to the information that we receive, right, in the headlines and social media especially. And I just want to say, I mean, not all the information out there is bad, right?
No.
Because if investors wanted to get educated, this is a great resource as well. There are great people out there, including us. I want to mention
make sure
we are on social media as well, right? So don't mention that at this point. That is great resource, right? But it also can go the other way around, and sometimes it's not always easy to see the difference. But
all right, cool. We'll move on to spaghetti wall. So Players Championship was this weekend. Went into a nice little shootout on Monday.
Did you watch a little bit?
No, I didn't.
I didn't either. But no, I heard it was
so
good.
You were busy with St. Patrick's Day then?
Yeah, just greening it all up.
So here's my. I'm gonna set the scenario because I wanted to try to relay the players with stocks. So every golfer at the Players faces a choice to either play it safe and take the easy shot, or take the aggressive shot and go for the risk. So for you guys investing in the current environment, given that we're in a correction, are you choosing a safe environment or an aggressive or safe investment or aggressive investment at this point?
Yeah, I'll start. I mean, I've been end of last year into this first part of the year, I was playing it probably more safe right down the kind of the middle of the fairway, and not taking any super big risks, and kind of taking off that in the portfolios I managed, taking off some of those stocks I thought performed really well, and kind of still owning them, but owning less of them. Now with the 10% pullback, I'm moving from that camp of play it safe to let's get a little more aggressive. But I think you have to also be smart about it. And I'm not like trying to, clear that big swamp that I know I can't do it. I can only do it 1 out of 10 times. I'm not just trying to pull out my driver and crushing it to get over it.
Okay.
So, but I'm definitely the ones that are more questionable. I would say, let's go for it here and add a little bit of risk. So I'm getting a little more risk on at this point in time. So if I had a risk budget, I was probably at closer to zero, that playing it safe. And now with this 10% pullback, I would say I'm getting half into ultra aggressive. Now, I mean, again, I don't think we need to pound the table either, because we just to back up, beginning of the year, our theme was bring an umbrella, and most of our forecasts are kind of a little bit, we always joke about they're a little bit meaningless, but I would say we were calling for a more normalized year, which is at 8 to 10 to 12%.
Yep.
I still think we're kind of in that camp. So if we're down 4% now, I think that's a good opportunity to start leaning into risk.
Lisa?
I'm on Keith's side. I agree with that. I think we did our work and our research before, right? Being a little bit more safe. And now we can go back and being a little bit more aggressive when there's fit. But I also want to mention, there is also value in the diversification itself, like from an investor's portfolio and perspective. Because when we see and always when we kind of go out and talk to advisors, we show the slide year-to-date asset class returns, right? We see the S&P down for the year, small caps down, crypto down, but gold is up, international is up, emerging markets. So there are pockets that work this year and work over the last couple of years. You do not necessarily know when this rotation happens and when these changes happen, but that's why you're diversified for, right? To be in it and to kind of collect the benefits from it, not having everything in one nest, basically. And so I think diversification is a part of safety, but you can also play it risky in some of the pockets.
Got it.
How about you, Tyler?
Yeah, I'm going a little.
You gripping and ripping it, or what?
Not quite. But I am in the more aggressive camp at this point. I'm still a little cautious. I've been on the consumer thing for a while, talking about my concerns on the consumer. I still think that is there. It'll be dependent on how long these tariffs stay in place. But I think if you're looking at a longer term investment, this is where I'm getting more aggressive.
Nice.
So last question for this is, what stock industry sector represents where you're at? Like, which stock are you picking in that maybe a little bit more aggressive camp?
Go ahead, Lisa. I'll let you go first.
I mean, like the safe bet would be more staples, right? More like the all day, everyday ones, slow and steady goes there. That would be the more safe one. I mean, pockets of tech, for example, could be interesting. Ours is still interesting and could be an opportunity, especially for investors that are kind of got priced out a little bit because they got so expensive. So that could be an entry point there. Again, very selective there. But the overall sector provides great opportunities, I think, still and at the moment with the pullback.
Keith?
Yeah, I think you want to get more aggressive, so you want to lean into just kind of how I manage different things. Like technology I'm a huge growth guy longer term. I believe those are the names you want to be with, especially over long periods of time. We had the Mag 7 had a big run for a couple of years. Now they've been a big pullback here. I've been advocating, you have to own some, all, kind of be more selective. When they're running, then you could own them all. Now, if you're looking for ideas for the next year, 2, 3, I think 2 great stock opportunities right now are Amazon and Meta. I think those valuations, Amazon hasn't been, 25 times forward PE multiple for the growth rate they have, hasn't been as cheap in multi-decades. And in the Mag 7 world, it was always kind of the middle of the pack performer, and now it's actually underperforming, even other than like Tesla's got a few different issues. NVIDIA was absolutely a home run. So the 2 barbells were been NVIDIA and Tesla. And then Meta, it trades at, I'm a big GARP guy. I like growth at a reasonable rate. So that's why I like Amazon. And then Meta would be the other play, is trades at 20 times forward PE for a growth rate that's probably 2x the stock market, and the stock market's trading at 20 times. So I think on this pullback, it had a period, if you go back like a month and a half ago, it was up like 20 straight days or something ridiculous. Not a lot, but just up. And now it's kind of flipped and it's kind of lost all that performance. And I think it's a reasonable stock that I own it, and I'm actually looking at adding more to them. So getting to that more aggressive. How about you?
People are going to get sick of me. Broadcom.
Yeah.
It's like my Walmart, right?
Yeah. Which is bouncing, Lisa.
Yeah. Broadcom for me, they're still big in the AI space. From a technical standpoint, if you want to go that route of the chart, 200 days holding it in pretty good. Yeah. Versus some of the other semiconductor names that are out there. So I'd go with them.
Oh, I wouldn't expect anything different.
Yeah.
And they're a leader in the semi space. They got a big software business that generates a ton of cash flow. It's a great company. Again, I'd put that in that high quality, long-term compounder.
So there you go.
There we go.
Episode 47. So like and subscribe if you like what we're talking about. And I guess we'll see you guys next week for episode 48.
Yes.
Other than that, take care.